Basically this recession was going to happen. Obviously, nobody predicted the coronavirus, and we're in a recession that's much worse than anybody would have predicted, even if you were looking for a recession. But because it's so severe and because it came upon us so quickly, we had basically forced liquidation in March, and that's what our data would suggest. And we just felt like the prices that we reached in that downdraft were pretty darn attractive. So from a risk-reward standpoint, that's when we decided to step in. That doesn't mean that we can't chop around and have volatility still high, but we do like the price action of the last couple of weeks. We thought last week's pullback was actually almost perfect in its sort of retracement. I think a lot of people were looking for a full retest, and so now we have a classic, a little bit of a chase going on. The thing I like about today's action, I know the prices did fade. We are seeing more cyclical leadership here over the last week, and even today we're seeing more cyclical leadership, which I think is healthy, because what that suggests is that as you go into recession, the market wants to look to the other side, and what the market will do is it'll start to buy these early cycle stocks when it feels like we're getting closer to the trough. So I do like the price action. I do like kind of the lows are in for this move. It's going to stay volatile, but we think this is an opportunity to be buying dips.
And Mike, the lows are in your view, based on what fundamental economic forecast? Because it's interesting, over the last week or so, you and a lot of the other investment banks have seen the economists downgrade forecasts, whether that's for GDP or unemployment, with a number of equity strategists like yourself saying that the bottom is in. So what type of economic forecast for the rest of this year are you pricing in with yet a still buy call for equities?
Yeah, I mean that's sort of the point, right? Is that the second quarter we now know will be the trough quarter. It's going to be so bad that we can't get another quarter like that. So typically markets bottom at the trough quarter. Now, once again, that's the second quarter. So could we have a retest of some kind? Are we going to chop around? Probably. And so our forecast is for a pretty sharp recovery, not positive growth in the third and even fourth quarter, but the rate of change will be getting better. And that's what the stocks will start to look forward to. I also would point out that, stocks aren't driven by the economy so much as they're driven by earnings. And everybody's trying to figure out what 2020 earnings are going to be. But as you know, stocks are, long duration assets. And they're not, I think from my standpoint, stocks don't really care about 2020. What they care about is what 2021 looks like. And so the worse the estimates get for the near term means the better the recovery will likely be in 2021. And that's what the stock market is trying to look forward to at this point.
Except for, Mike, we're still seeing moves like yesterday was an up day of 7%. And the only real times in history that we get moves like that are during bear markets.
Well, yeah, we're at the end of a bear market. So, it doesn't mean that it has to all be over at once. And I appreciate, the biggest market rallies happen during bear markets. But look, we also see big short covering rallies at the beginning of bull markets. So, who's to say which one this is? And I think it's, like I said, it's going to remain floppy. It's going to remain choppy. Market leadership is probably going to ebb and flow back and forth. But we think ultimately, we're going to make progress forward, and we're going to see leadership change. That's probably the most important thing for investors to think about now, is that we've been in a defensively oriented market for 2 years, and now you need to actually start adding cyclicality into your portfolios at a time when it's the scariest. And so that doesn't mean 100% cyclical.
Mike, sorry, we're running out of time. Can you just clarify how you can make this view without knowing when America can get back to work, whether there'll be enough testing, whether our hospitals will be in good enough shape? Questions on the health side that, nobody can really answer right now.
But that's why we have an opportunity, Sarah, because nobody knows. And that's why prices are attractive. We're getting paid to take some of that risk on. Of course, we don't know the answer. Of course, there's risk in making investments at any time. But I would argue that that the risk reward today, ironically, is probably better than it was, when we were trading at 3,400, when all the good news was priced and there was really nothing to look forward to that could surpass that. So that's the beauty of the stock market. The stock market is, a price on the future. And, when prices are attractive, that's when you have to step in.